ETFs and mutual funds get compared constantly, usually with a table that leaves you no clearer than when you started. So here's a more useful framing. Both are a pooled fund holding a basket of investments. Same regulator, same rules, often the same manager running the same strategy. The differences are not about what is inside, they are about how you get in and out and what that does to your tax bill. 4 things actually change. First, when you buy. A mutual fund prices once a day. After the close, the fund adds up what it holds, divides by the shares outstanding, and everyone who ordered that day gets the same number. 10 in the morning, 3 in the afternoon, identical price. An ETF trades on an exchange all day, at whatever price a buyer and a seller agree on in that moment. For a long-term holder, this matters less than it sounds. Where it does matter is control. You can set a limit order on an ETF. You can exit at a known price during a volatile session instead of finding out at 4 o'clock what you got. Second, and this is the one that shows up in actual money. When a large holder leaves a mutual fund, the fund usually has to sell holdings to raise the cash. Selling realizes a capital gain, and that gain gets distributed across everyone still in the fund, including people who bought last month and have no gain of their own. You can lose money in a fund and still owe tax on it. An ETF can hand over securities instead of cash. No sale, no realized gain, nothing passed through to the people who stayed. 2 things to be precise about. That advantage mostly disappears inside a retirement account where distributions are not taxed as they happen. And it is a tendency rather than a rule. Some ETFs do distribute gains, particularly in fixed income and in strategies that trade heavily. Third, cost. ETFs are cheaper on average, but the average is high at a wide range, and an expensive ETF costs more than a cheap index mutual fund. 2 costs behave differently here. The expense ratio works the same way in both, taken out of the fund every year without appearing on your statement. The spread exists only in the ETF. It is the gap between the buy price and the sell price, and you pay it going in and again coming out. On a heavily traded fund, it is trivial. On a thin one, it can quietly exceed a year of expenses. Fourth, how you get in. Mutual funds often require a minimum initial investment. An ETF requires the price of 1 share, and with fractional shares, less than that. But mutual funds still handle automatic recurring contributions in exact dollar amounts more cleanly, which is a large part of why they still dominate inside retirement plans. Here is the clearest way to see that the wrapper and the strategy are separate questions. Bridgeway ran a small cap value fund as a mutual fund starting in 2010 and converted it into an ETF in 2023. Same research process, same managers, same holdings. What changed was how investors access it and how the tax mechanics work. When a manager offers the same strategy in both wrappers, the decision between them comes down entirely to those 4 differences. And mutual funds are not simply the losing side of this. Inside a workplace retirement plan, they are often the only option, and the tax advantage is moot there anyway. For automatic contributions in fixed dollar amounts, they still work better. For a manager building a position quietly over weeks, publishing holdings every morning is a real disadvantage. And if you already own one with a large embedded gain in a taxable account, switching triggers a tax bill. A better wrapper is rarely worth paying for early. So the wrapper is usually the smaller question. 2 funds running the same strategy in different wrappers will behave nearly identically. 2 funds in the same wrapper running different strategies will not behave alike at all. What it holds, what it costs, and whether it does what the name says matter more than the label on the outside.